Welcome to our financial management course. Today we are going to talk about something that is both powerful and potentially dangerous if not fully understood: margin and leverage. Now, instead of starting with definitions, I want you to experience this idea. So imagine this. You have $5,000 saved up. You've worked for it, maybe over time, maybe through effort and discipline. And then you see an opportunity, an investment that looks very promising. But there's a problem. To fully take advantage of it, you would need $10,000. So now you are standing at a decision point. Do you walk away? Do you wait? Or do you find a way to control something bigger than what you actually own? That moment is where margin and leverage begin. Let's continue that story. You go to a brokerage firm, and they tell you something interesting. You don't need the full $10,000, they say. You can invest anyway. You put in your $5,000, and they will lend you the remaining $5,000. Suddenly, you are not limited by your own capital. You are now controlling a $10,000 investment. This is called margin. Margin means you are borrowing money to buy an investment, and your existing investment acts as collateral, So your opportunity expands. But so does your exposure. And that's something many beginners underestimate. Now let's think about what just happened. You used $5,000 of your own money to control a $10,000 investment. That means your leverage is 2-to-1. Leverage is simply a measure of how much larger your investment is compared to your own capital. But here's the important part. Leverage doesn't create value on its own. It simply amplifies outcomes. If things go well, your gains become larger. If things go poorly, your losses also become larger. Leverage is like a volume knob. It turns everything up. Let's imagine things go your way. Your $10,000 investment increases by 10%. Now it is worth $11,000. That's a $1,000 gain. But remember, only $5,000 was your own money. So from your perspective, you earned a 20% return. That's powerful. That's exciting. And that's exactly why investors are drawn to leverage. It allows them to do more with less. It can accelerate growth. It can make opportunities feel larger and more accessible. But there is a hidden cost, and it shows up when things don't go as planned. Now let's change the story. Instead of going up, your investment drops. Your $10,000 position falls to $7,000. But you still owe the broker $5,000. So now your equity is only $2,000. That's a significant loss. And here's where something critical happens. The broker may issue a margin call. They require you to add more money to maintain your position. And if you cannot, they may sell your investment without asking you. This is called forced liquidation. And it often happens when prices are already low. So losses are not only larger, they can also happen faster. Now, margin is just one form of leverage. Leverage exists across many financial markets. In options, you can control large positions with a relatively small premium. In futures, leverage can be even more extreme. For example, you might control $100,000 worth of assets with only $5,000. That's 20-to-1 leverage. At that level, even small price movements can have large financial consequences. So leverage is not rare. It is deeply embedded in modern financial markets. Now let's talk about something equally important: people. Because leverage does not just affect numbers, it affects behavior. When investments are going well, people often become overconfident. They increase their positions. They take on more leverage. When things go poorly, people hesitate. They delay decisions. They hold on, hoping for recovery. And stress builds. Margin and leverage amplify not only returns, but also emotions. And that is where many mistakes happen. Let's return to the beginning one last time. You had $5,000, and you had a choice. Now you understand something deeper. Leverage allows you to control more, but it also exposes you to more. It can accelerate success, but it can also accelerate failure. There is nothing inherently wrong with leverage, but it must be understood and it must be respected. That is what financial management is about. Making informed decisions, understanding trade-offs, and managing risk carefully. Thank you for being here today. I'll see you in the next lecture.